Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. I continue to read that the Federal Reserve and central banks are trapped. I've also made such statements. The difference is that others suggest that the setters of monetary policy have few, if any, real options left open to them. In my opinion, that is simply not accurate. Their escape routes may not be obvious, but they exist and can be expected to be taken when the time is required. Some may be public, some stealth, and others just changes of regulations which they are responsible for setting and enforcing. I've witnessed all of these in the past. I want to consider just one of those escape routes in this session. A possible solution to a number of seemingly intractable problems involves the use of fiat currencies. No, I'm not talking digital currencies, though they may play a role, but rather the use of the US dollar reserve currency as a control lever. As such, I'd like to discuss the items outlined here. We need to expect the unexpected. It has been my experience that the markets always do the least expected, which results in the maximum people losing money. It is why being a contrarian investor is so successful an investment approach. Our recent videos have clearly laid out some very worrying concerns. We were very detailed in our three-part series outlining the analytics around identifying market tops. As we were also in the video Grab a Life Vest, 4 tsunami waves are about to hit all at once. As clear and factual as we were, along with identifying proven analytics and technical analysis that supported our conclusions, what we chose not to address is what will the powers to be do, this discussion being pure speculation. That is what I'm going to do now, speculate with you. Not for one moment should we consider that the central banks are unaware of the magnitude of the problem. It is a core reason for their existence. When I say their job, I'm talking about quite literally an army of economists, analysts, bankers, consultants associated with the central bankers in every country on the face of the planet, but also the powerful coordinating role of the Bank of International Settlements, or BIS, in Basel, Switzerland. It is their job to stop, or at least mitigate as much as possible, destabilizing economic and financial developments within any country, region, or most importantly, globally. I'm not for one moment suggesting they are infallible or all-knowing. I am, however, suggesting everything we laid out in our videos they are well aware of. I might even mention that we have a large base of long-term subscribers who actually work for these entities. So let me tell you what they see, and what is likely one of their alternatives, including in their escape route planning. The US dollar is on all their radar screens. It is one key metric that has enormous impact and requires careful consideration in their policy formulations. What is well understood by all is that the country's currency follows over the longer term the direction and fundamentals of what is referred to as the twin deficits, or in most cases, surpluses. The twin deficit consists of a country's trade balance plus its government fiscal balance. In the case of the US dollar, the US has been running consistent deficits for decades, going back to the late 1960s. Shown here, you can see that the dollar has been in a downward trajectory along with the increasing twin deficit. You can't really trade it in the short term, or for that matter, even in the intermediate term, but in the long term, you have a pretty sure thing here. What the central bankers see is that the U.S. trade deficit, shown here, has went over a COVID cliff, and things have yet to get any better. Worse is the fact that being primarily an import nation, the supply chain shortages may in fact actually be slowing the real collapsing structural weakness in U.S. trade balances. For decades, we have been a nation that consumes more than we produce, and it is getting worse as even more manufacturers shutter or taken over by larger foreign suppliers or continue to move offshore or to Mexico. The other part of the twin deficit is the federal government's fiscal deficit. This can only be considered as out of control as we continuously hike the debt ceiling and entertain multi-trillion-dollar political programs that are simply unfundable, whether you support the spending or not. The reality to the central bankers is trillion-dollar deficits that must be financed. since we now spend much more than we can take in through taxation. This chart doesn't even take into account what is currently pending on the policy docket in the U.S. Congress. Both these deficits have to be financed, which is reflected in the U.S. current account. Even it is plummeting as more and more foreigners are investing in other countries. The U.S., since the COVID shock and the last U.S. election, is not seen to be as attractive a destination as it once was. This doesn't bode well for either the U.S. dollar or U.S. bonds, which will require higher yields to attract foreign investment to avoid debt monetization. Outright debt monetization normally quickly destroys the value of a country's currency. Many professionals have long considered the U.S. dollar seriously overvalued as a direct result of its status as the global reserve currency. This, however, is slowly eroding as a result of U.S. policies that have resulted in countries de-dollarizing. We laid this out in great details in our free 2019 thesis paper, De-Dollarization, which is available for download on our site. Additionally, we have exploding use of cryptocurrencies, which takes away from the global need for holding U.S. dollars. It is clear to global central bankers that the U.S. dollar is going to fall. Many would say it is best to manage that devaluation than wait for a cataclysmic and destabilizing shock, which not only will reset the dollar's value, but precipitate global unintended and collateral consequences. Let's look at what the dollar's technical charts show from a longer-term perspective to see if they are sending us a picture of what to expect or any critical correlations or boundary conditions. Regular followers are quite familiar with the two US dollar DXY charts we often use in our newsletters. So far, they have been quite prescient in determining both price targets and the timing of them. The longer-term chart shown has guided us for a few years now and most recently helped us from a 2020 pre-COVID high of 103 in the DXY to a late October 2020 low of 89 to the most recent bounce to just over 94 in the DXY. We feel this bounce is going to go to approximately 95 to 96 is part of a B retracement in a downward ABC drop shown here in the US dollar. The intermediate chart has detailed the corrective leg of that ABC from what is labeled as the major long-term support at approximately 89. We'll come back to that number later. Technically, it appears that we are near the end of this rising correction. But are we? A lot has changed since we identified approximately 94 as a Q3 2021 DXY target. So where to from here? That's the question. Let's revisit the chart that we initially used to guide us in developing the first dollar chart we just showed. This chart goes back to when the U.S. went off the gold standard and became a fiat currency, not backed by anything other than political promises. We drew this MATA SII dollar chart not long after the 2000 dot-com bubble implosion, where the two circles you can see here actually touch. We did this as part of our MATA SII trigger services. Our DXY charts we just showed have always traced within it and adhered to its boundary conditions and trend lines. You can see two control-gone circles, which rest on a descending black trend line illustrating the US dollar's steady decline relative to its fellow fiat currencies. You can also see a connection line from the 1985 US dollar devaluations beginning as a direct result of the Plaza Accord, through the dot-com bubble to a touch of the downward trending US dollar. You can also see that since 2019, it has exited the two grand cycle circles and basically followed the trend channel drawn in red. Drilling down, you can see here that the red trend channel was broken to the downside in early November 2020 as a result of the U.S. presidential election. You will notice we now have a smaller fractal circle, which we recently added, with a lot of similarities to the larger grand cycle circles. It's the nature of fractals. It now appears that the DXY wants to test the underside of the red channel before heading lower. Drilling down into the smaller current circle, you see a test of the lower red channel would be approximately 95.2 in the DXY. You will also notice a trigger proprietary HPTC or high probability trading zone at approximately 88.824. This matches extremely close to the major long-term support line drawn on the intermediate-term dollar chart we showed earlier and I asked you to pay attention to. If accurate, it is quite a drop from the red trend channel in a short period of time between November and Q1 2022. Any such move would no doubt have an impact on the U.S. debt market. So what is the risk-free benchmark, which is considered to be the 10-year Treasury note, technically telling us? This nearly 30-year chart shows an extremely tight and controlled channel drop in the yield for the 10-year note. When it hits one or other of the upper channel trend lines, the yield trend reverses downward. Currently, it would suggest if the 10-year yield was to approach 2.01 or 2.36, we could expect the next reversal to occur. We know for certain the central bankers are highly concerned with any erosion in the wealth effect and the value of the financial markets, specifically the highly leveraged equity markets, which, if they drop substantially, would trigger a massive destabilizing force in the overall global financial markets. The obvious question in determining a central bank escape route is to begin by determining whether there's a possible correlation between the US dollar, the 10-year yield, and the equity markets. What we did here is consider how the central banks would look at the longer-term rising trend of the equity market, using the S&P 500 as our proxy, to the longer-term trend of the falling yields on the 10-year note, which we just looked at. To do this, we actually multiplied them versus other normal correlation approaches to arrive at this extraordinary simple control channel. What it tells us is that when yields and equities rise together, they will reach an upper inflection point where their trend is abruptly reversed. This occurred at the peak of the 2000 dot-com bubble and during the 2008 VIX debacle in the short-term funding market. We also see when yields and stocks fall together, they reversed at the bottom of the 2008 financial crisis and the selling off during the early 2000 COVID market drop. When I say will reverse, I'm saying historically this has been the controlling pattern currently in existence. You can see on the right we are currently in a period of rising equities and rising yields. The question is, will this rise further or reverse here as it did in 2007, forewarning of a 2008 financial crisis? We saw in our dollar chart we should expect further movement upward to test the underside of the red trend channel. We also saw on the 10-year yield note that yields are likely to continue to rise further under inflation pressures until we touch one of the upper inflection points. If this was to be the case, we have the strong possibilities of more upside before reaching the upper boundary of this control channel, a channel the central bankers are no doubt well aware of, a channel that seems as tightly controlled, frankly, as the 30-year channel for the 10-year Treasury note we showed previously. For further confirmation, we then overlaid this control channel with the S&P 500 index itself. If we had followed the channel, we would have gotten in and out at the right times. Actually, we did. We have done extraordinarily well. Maybe the powers to be and global elitists know something we don't. Maybe they aren't as smart as we think and may just have a better idea of what to look for. That's what we found. So how does this tie into the central bank's escape route through the US dollar? Now that we have considered how the Treasury note works with the S&P 500, let's try and tie what we have found so far together by looking at how the dollar has performed relative to the 10-year Treasury note. Here we get a third extraordinary controlled long-term channel. Only global central bankers could get excited about something like this, or maybe better expressed, would be terribly concerned if they didn't have this sort of control to manage coordination within. What we did here is divided the US dollar DXY by the 10-year note yield, the TNX. We then took a 35-year regression of this relationship. Incredibly, the channel only deviates once within the controlling channel within plus or minus 1 standard deviation. You can see there was only a brief spike associated with the dramatic takedown of yields during the COVID market sell-off. there is only one way all three channels would be this well behaved in aggregate. They're managed within understood boundary controls to manage stability. To compare, we place the regression channel of the DXY TNX to the DXY below it, then the TNX, then the S&P 500. Let's now do some central bank escape arithmetic. First, the DXY and TNX ratio. If we move to 95.2 on the DXY, our lower red trend line target you've seen earlier, and to 2.36 on the TNX, the upper trend line inflection point on the TNX chart, dividing 95.2 by 2.36 is equal to 40.33. This is exactly the bottom of the 35-year regression channel. Surprise! If we were then to move to the upper regression trend line at 72.7, and if the DXY was to fall to the lower high probability trading point we showed earlier at 88.24, then the 10-year note yield could be expected to trade down at 1.21. A lot of people think that's what is to be expected with yield curve control put in place. Coincidence? Likely not. Now consider the DXY and XPX. The difference in 95.2 to 88.24 in the DXY amounts to a 7.3% drop. When dollar falls, usually stock values go up just because they're more expensive at that dollar value. A negative 7.3% drop in the XPX from its current level of 43.90 would take it to approximately 40.69 in our current arithmetic. This compares quite closely to our technical target for the XPX of 40.50, which we outlined in our thought experiment in part 3 of our series on identifying a market top and what was to follow. That is, under the lens, our October of issue, The Crowd Will Be Wrong About the Coming Market, part 3. If the dollar was to fall even further to our 79.96 target circled in red, this would be a further 9.38% devaluation in the dollar, that is 88.24 to 79.96. This would potentially take the S&P 500 up to 48.2. This has been our long-term top for the S&P 500 for some time now, based on our parabolic projections. There are 3 of them, which we have shown here in many prior videos. So what can we conclude from all these coincidences in numbers and channels? In 1985, the Plaza Accord agreement was reached when the G5 at the time was in a similar awkward, potentially destabilizing position. The historic 1985 Plaza Accord, signed at the Plaza Hotel in New York, was a pro-growth agreement signed by what was then known as the G5 nations: West Germany, France, United States, Japan, and United Kingdom, the key countries in the world that were driving the global economy at that time. The purpose was to force the United States to devalue its currency due to current account deficit, approaching an estimated 3% of GDP. Unbelievable. Today it's 11.8% and widening significantly again in the latest quarter. The agreement enacted the manipulation of the exchange rates by depreciating the US dollar relative to the Japanese yen and German Deutschmark specifically. Substitute emerging markets in Asia for Japan and Germany then, and you have a somewhat comparable situation that can be used as a model today. But it's worse than that. The seriousness of the global supply chain disruptions is causing serious problems in many nations, but particularly in emerging markets, where their debt is often denominated in US dollars, which you now can least afford at this value of the dollar. With the value of dollar rising and their exports falling, it is placing many nations in the world in an increasingly parallel situation with their debt reparations, including Europe, who has funded a lot of this debt through US dollar payments. The last thing the world can least afford presently is a stronger US dollar. This is especially true since the US dollar is probably overvalued by, in our estimation, 40%, based on US effective deindustrialization of its manufacturing prowess and declining real productivity. Additionally, and also very importantly, the U.S. debt growth increasingly needs to be financed by foreigners. A cheaper dollar would dramatically assist with this, and a reduced credit rating or a 1985 style Plaza Accord agreement may soon become a forced outcome. The point of this discussion is that the central banks have a way of kicking the can down the road once again, a way of stabilizing a broken system yet again. After another scare, expect new market highs before this collapse in sound money is complete. The question is, how do you protect your purchasing power from a depreciating value of the currency your assets are all denominated in if you're an American? And frankly, a lot of people around the world who denominate them in US dollars. Check out our extensive video library for answers to that question, which we have been answering for years now. As I always remind you in these videos, remember politicians and central banks will print the money to solve any and all problems until such time as no one will take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped within policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I use the word trapped. There are always little things that they can do, as I've just outlined. I'd like to take a moment as a reminder. Do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom actually been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2021 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.